So, what are the differences between a regular stock and a stock fund, and what are the advantages and disadvantages of each of those options? Now, it's very easy to explain. Over here you have a stock. This is a regular stock which represents ownership in one company. If that one company does well, the stock goes up. If that company does bad, the stock goes down. Now, a stock fund is a group of many stocks. And you get the average of all of those companies. So if there's 100 companies and 20 of them does bad, 80 does well, the price will go up. So there's a lot less risk involved in a stock fund compared to a regular stock. But you lose some of the potential big gains on your investment, because 100 stocks, the average of all of those companies, will move a lot slower than one company can. One company can double your money in 1 year, a stock fund will not. And to illustrate this, we can paint two graphs. One showing how a regular stock will go and how a stock fund will usually go. Now, the red pen is going to represent a regular stock. And over time, a regular stock will go something like this. It will have a lot of ups and downs, but over longer periods of time, it will go up. Just like any other stock. Now, a stock fund will have a similar development, just with a lot less swings in the price. So it might look something like this, where over time it will still go up and you'll have a lot less swings, but you'll lose out on some of the potential gains of a regular stock. Now, likewise, if the individual regular stock turns out to be a bad apple, you can lose a lot more money than with a stock fund, which will have an equally slow development in a bad year. So, with a regular stock, you have ownership in one company, and if that one company turns out to be a good apple, you can make a lot of money, while in the stock fund you might only have 80 bad apples but 20 good ones. So a stock fund will always balance the average out. Now, another thing to point out about stock funds is that you have to pay a little bit every year of the money you make to whomever owns and runs the stock fund. So maybe you have to pay 1% of the money you make every year, and that will make up a huge difference and have a huge impact on how much money you make over many years, which also sends the stock fund's performance a bit down compared to a well-performing singular company. So there's advantages and disadvantages with stock funds, definitely, and I think personally that a balanced portfolio consists of both regular stocks and stock funds, which allows you to have a low risk portfolio but with some potential gains if you find some good companies. Now, as always, if you want to find out more about the topic I touched on today or anything else regarding getting started in the stock market, you can head over to investingforall.net